got a question here on a HECM, Alan. I
Okay.
would love to hear what you think about taking out an FHA HECM. Remember that good old Wade Pfau talking about
Yeah,
HECMs?
he kind of resurrected that whole concept.
Yes. It's basically a reverse mortgage,
Right.
home equity conversion mortgage, to be exact, I believe is what that stands for.
I think so.
At the beginning of retirement at 62 to help insure for health care and longevity risk. See Wade Pfau's articles.
There you go.
We had Wade Pfau on our show.
We did a couple times.
Yes, we did. Very smart individual.
Yeah, super smart.
Instead of doing it much later as a last resort when money runs out or spending a lot. All right, so I guess I get the gist of his question. Is yes, I think it makes sense. I mean, I don't know.
Well, the only thing, there's costs involved.
Yeah,
right?
but I mean,
these loans, you can, there's different flavors. You can have it just be a line of credit and just draw on it if you need it, and so it's there. So that's one way to
and that
go.
line of credit increases each year as you age.
That's right.
So at age 62, you take out this line of credit, right? There's costs associated with taking out the line of credit, but then the line of credit grows at a certain rate, depending on where the HECM market is or the reverse mortgage market is, right? So each year, so you take this thing out at age 62, and then, at 65, let's say your home equity conversion mortgage is 300,000 at 62.
Right.
And then at 65, it could be 350,000. At age 70, it could be 400,000.
Right.
And so it's just still a line of credit that you'll never, ever have to pay back. If you pass, someone will pay the money, but you don't necessarily have to, because it's basically a reverse mortgage.
Yeah. Well, you will have to pay it back if you sell your home.
Correct.
Or if you go to a nursing home or something like that. You got to do it then.
But I like that strategy. I'm like I'm like 30 years from that age. So
30, really? How's your math there, buddy?
62. Well, it's like 40 years from now. I will have to make that decision.
You're 12.
But I like it. We had Wade on. He talked about the pros and cons of that. That was a few years ago.
One of the reasons why Wade likes it is because of the sequence of returns risk, which basically means that the market may go down while you're trying to create a retirement income because you've already retired from your assets. And what he said is, you know what? The market goes down. Don't pull money out of your account because it'll be hard for it to recover. Pull some money out of this reverse mortgage line of credit, right? And so if you do that, then you keep your you keep your portfolio intact. I think that there were other things too. I mean, he talked about using money to pay taxes on Roth conversions and things like that. So yeah, I don't think it's a bad idea either. But there's cost to do that. So just be aware.
Yeah, it depends on your liquidity. If you have other cash, or depending on how much you spend and what your investment portfolio looks like, you might not need it. Others probably, it might make sense to at least take a look at it.
Yeah, and you can always get it later too if you didn't get it now.
Sure.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.